All right, class, here we are, part 2, chapter 4, and things that are excluded or deductible for AGI. Roth IRAs, like any other IRA, the earnings is not included. So any interest or dividends that are made inside the IRA are not included in income. Now, so some rules about contributions. So you can have a Roth IRA in the first place. $5,500 is a max. $6,500 if you're over age 50, actually 50 or older. So that's an extra $1,000. But you can't make those if you are your income is too high. And you see the phase out ranges there. We always round to the nearest $10. Okay, minimum contribution is $200. So some rules about how that's determined. So 48 wants to contribute the most he can. His AGI is 124. All right, so he's over the threshold by 4,100. The phase out range is 15,000. Okay, so we take the 4,100 difference, we divide by the 15,000, we multiply it by 5,500 to get the reduction factor. Take it out and round up to 39.97 up to 4,000. So Deb is married. In this case, is a little different. So we use a different phase out range. It's 189 for married filing jointly. So we take 191.6, we subtract it, we get the 2,600 divided by 10,000 multiplied by 6,500. That's how much you reduce it. And so the most she could deduct, or most she can contribute. Now then the Roth IRA is just, you can't contribute more than what this calculation is, 4810. If you do, it's considered excess contributions, and there's a penalty tax for that. For putting more money in than if you don't take it back out quickly or something to correct it. So, what can you do with the Roth IRA? So you can make tax-free and penalty-free withdrawals after a 5-year waiting period. So you got to wait 5 years, and then you got to wait till you're after 59 and a half, or there's a beneficiary with a death, okay, or there's a disability, or you use the money to buy a new house. First time home buyer, first time you buy a house. Education savings plans. These are money you put aside to pay for education expenses in the future. CESA or covered L accounts, $2,000 per beneficiary. These are not deductible. All right. This is a 6% penalty on excess. If you put more than that, you can do that per beneficiary. So if in theory you could set one up, if you had 10 grandkids, you could set one up and you could give $2,000 per grandchild, $20,000 total. Okay. There's also 529 plans. These have become the favored way to save because there is less of a limit. So there's no $2,000 limit. You can put a lot more in. And then states have set them up wanting you to save in their state, and so they've given you some pretty good deals on those. So most people have moved from this covered L accounts to these 529 plans. So the idea is that it grows in there. You don't have to report the income on interest growing in there as income, but if you pull it out for the wrong thing, you can have penalties. Okay, so it's not taxable. None of it is taxable if you take it out, as long as you use it for qualified education expenses. All right, and you've got to do that once beneficiary turns 30. There's going to be a penalty. However, you can roll that over to another beneficiary if it was in the same family. Okay, if there's money left in a 529 plan, that goes back to the person who made the contribution in the first place. New plans, savings plans, these are just been instituted in the last 2 or 3 years. You see there contribution limits and who is able to use these. Again, non-deductible, like a Roth IRA. Discharge of debt. You owe somebody money. You say a credit card company. You call them and tell them you cannot pay it off. There's no way, and they forgive part of it. They say, okay, instead of owing us $15,000, you only owe us $6,000. It's a $9,000 forgiveness. Typically, this is including gross income, but there are some important exceptions. If you are bankrupt or insolvent at the time of debt forgiven, it is not included. So you kind of have to go through this long process of proving that your liabilities are greater than your assets when that happens. The exclusion on debt for non-taxpayer's main home. We used to have an exclusion if it didn't matter if you were insolvent or bankrupt. You could be forgiven on your home, but that expired at the end of 2017. So it would have been not included in 2017. It would be in 2018. Some deductions for AGI. This is now a separate schedule, Schedule 1, not on the Form 1040, but a separate schedule. Notice that first one. This is very narrow. Business expenses of reservists, performing artists, and fee-based government officials. That's it. Everybody else, no go. Okay. Educator expense deduction. That's for buying supplies. If you're a K through 12 teacher, and it's only up to $250, so it's not a lot of money. Health savings account deduction, we'll talk a little bit more about that. Moving expenses now for 2018 is only for active duty military. Everybody else does not, no one else gets to deduct moving expenses anymore. All right, employer share of self-employment, or half of your self-employment tax, and we'll see how that works a little more carefully in Chapter 7. And contributions for self-employed retirement plans, and we'll visit that in more detail in Chapter 7 as well. Health insurance premiums, if you are a sole proprietor or a partner, in a partnership, you can pay for your health insurance and deduct it for AGI. Penalty on early withdrawal, saying you pull money out of your CD and they charge you a penalty because of that. That is the deduction there. It's not going to be a lot of money. Alimony, we talked about that in Chapter 3, is deductible to the payer spouse for divorces prior to 2019. IRAs, the regular IRA deductions, and student loan interest. Now let's look at these different scenarios. HSA, you put money aside, it's deductible, and then when you take it out, you have to use it to pay for medical expenses. It's a way to save for medical expenses. Maximum are given there. You can put more if you're over 55. Okay? You do not have to include the amounts pulled out of the plan as long as you use them for medical expenses. If you do this for something else, 20% penalty. Self-employment. All right. So 15.3% maximum. 128.4 was 2017. 2018 is 129, I believe, something. So that we'll cover that more in Chapter 7. These are contributions. Again, those will go in Chapter 7. Health insurance. Notice that the amount of deduction here cannot exceed the taxpayer's net profit. So if you have a small business, you buy yourself insurance because you don't have it with anywhere else. You can deduct that, but only if your business is making some money. So if your business is losing money, you're going to be up a creek because you're not, besides the fact that you're losing money, but you're not going to have a limit on your health insurance deduction. You won't be able to use this deduction. All right, penalty doesn't come up very often, but you see there what the rules are. Alimony. All right, a little bit more about traditional IRAs. $5,500 maximum. This is your actual deductible, so that you deduct it now. When you pull it out later, you're going to have to pay taxes on it. Okay? As long as there is earned income, couple can. So, for instance, if one spouse makes $25,000, the other spouse stays home and doesn't work, or something, doesn't have any income, full-time student, whatever, they can still make a contribution for both spouses as long as their earned income is more than the amount of the contribution combined. Okay? Now, if you're not an active participant in an employer-sponsored retirement plan, you get to do the full amount. So if you don't have a 401k or some other retirement plan at work, then you get to use the IRA, regular IRA, to the maximum. If you are active as a participant, or your spouse is, then you have some limits. Okay? So here is the phase out if you participate. So you participate if you're single, you're phase out of how much you can deduct. If you're over $73,000, you participate at work, you cannot make a deductible contribution to your IRA. All right? If you're married filing jointly and your joint income is $121,000 or more, you cannot, and you participate at work, you cannot make an IRA contribution that is deductible. If your spouse participates at work, but you do not, all right, you can still make it a contribution, a full IRA contribution up to, when you get to 189, that phases out and it's gone by 199. So, Matt and Mitzi, okay, want to make a largest possible contribution. Mitzi's not an active participant, Matt is. AGI is 103. Let's look at Matt. Okay, he can make $6,500 because he's over 50. He's active, so he's gonna have a phase out. Threshold is 101. He's over by 2,000. That's 10% of the phase out range. So his amount deductible is reduced by 650. Okay. So his contribution is $5,850. Now we're looking at Mitzi. She's not an active participant. Her modified threshold is 189, so that's when it starts to phase out, and they're not anywhere close to that. So she can contribute and deduct $5,500, not the extra $1,000 because she's not over 50. If you pull your money out of an IRA early, you're going to pay a penalty for early withdrawal, unless it is for death or disability, or pay medical expenses, health insurance, higher education expenses, or a first-time home buyer. So there are some exceptions that will get you out of the penalty. You're still going to have the income tax on the withdrawal, on all of those. That only gets you out of the penalty tax. Student loan interest only up to $2,500. All right. For student loan interest deductions, that's the maximum. Phases out for between 65 and 80 for single, and 130 all others, and all filing statuses except for married filing jointly does 135 to 165.